where is the electricity going to come from? If we assume that the electric car is happening, that we are in the iPhone moment of the electric car, well, we're going to need a lot more electricity. We've done this math years ago at Orange Capital Partners, and I don't want to quote too much, but it you can easily think about it this way. If we replace our complete transportation system from fossil fuels to electricity, we probably need to double our electricity capacity. But this is really very back of the envelope, and it doesn't account for the fact that what we expect is that we will have a lot more driving, particularly if autonomous driving kicks off. So the question is, where's the electricity going to come from? The idea is that we buy Natgas, uranium, and potentially solar, and invest in companies that actually help us provide more electricity for the future. This is Not In the Wrong podcast. It's October 5th, 2021. This is Delco. For the day, the fund is up 97 basis points. The market's up 1.4%. We are up for the year 9.5%. The market is up 15.9%. We're underperforming by 6.4%. So I want to start with the idea and then talk a little bit about the pros and cons, and finally give sort of an analysis, the way we think about this. Actually, we had this in the morning meeting today, so this is very relevant. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. And I think sometimes I talk about epistemology, David Deutsch, philosophy. Sometimes I talk about daily business, and this is one of those. Daily business, practical experience for people that care about this type of stuff. I think today's episode will be very useful. So the idea is we buy Natgas, uranium, and solar. Why? Because we believe that the electricity infrastructure will have to change if we're right on our thesis that transportation will go electric. So this is basically sort of the next level of development. If you want to have more electric cars on the road, you need more electricity. And where is the electricity going to come from? It's going to come from three sources: Natgas, uranium, i.e. nuclear, and sun. We are staying away from wind, but wind is certainly also an option. But let's not go there now. We also believe that a lot of software, intelligent grid, autonomous grid, and all those kinds of things will play a role. We hope that Tesla can capture some of those with AutoBidder and other ideas. But overall, the fundamental idea here is really that we need the electricity from somewhere. And as a hedge fund, we channel capital to where we believe the future innovations will come from. And this might not be a fundamental new concept. It might not be a new engineering practice a la electric cars, autonomous driving, etc. But it's still needed. It's still necessary. And what's actually most important is, and this is something that a lot of macro people believe in. And for example, Hugh Henry in his podcast talks about this. So I just want to share it here and also give these people credit for that. So we had a similar situation in the year 2000, very similar. In the noughties. So from 2000 going onwards, we had this renaissance of nuclear. We had Natgas going through the roof. We had a lot of these types of developments back then. And for whatever reason, back then, it didn't work out. I think you could have probably summarized the situation in the noughties as China becoming an economic power and the US housing bubble coinciding, giving the perfect storm, demand for energy going through the roof, and you had all these things going through the roof as well. Plus you had sort of this renaissance in nuclear power in particular, because we were just running out of energy. Then the housing crisis, the bubble burst, and we have a calamity and all that stuff. Now this is coming back, and very often when assets like this come back, they tend to actually keep rising. So this is anecdotal. I don't think I can prove this, nor can anybody else prove this, but I think fundamentally you can think about it this way. You have a certain dynamic, which is the world is growing, in particular China and other so-called third world countries are turning into first world countries in the sense that they're industrializing. They're becoming industrial, service-oriented, high energy consuming countries. Just to be clear, higher living standards always require more energy. There's no way you can have a higher living standard and not use more energy. You can use it more intelligently, you can distribute it more intelligently, you can, and this has happened in the US in the last 10 years, almost, more than 10 years since the housing bubble. We actually consume less electricity, but that's not necessarily because our living standards have gone down. It's for other various reasons, such as more efficiency in the house, in industrial applications. We have a lot of different types of savings. We have in smart grids and all that kind of stuff is adding to the electricity demand actually being stagnant. Now, what we're predicting is not necessarily a change in electricity demand to the upside. What we're predicting, actually, yes, we are predicting that, but what we're predicting here is not necessarily that we will consume more energy, just to be clear. We will probably consume more energy, that's very possible. But what we're definitely predicting is that we will consume different types of energy, in particular electricity from renewables. We believe that the price of electricity, in fact, should come down for that to happen. So we compare electricity to, for example, storage, networking, and those types of things in the IT business, because this was also the bottleneck, and then the internet and the whole cloud revolution and what we're going through right now it just increased the demand for bits dramatically, but that was possible because the price for bits came down. And we believe that the same should happen here, that the demand for electrons should go through the roof because the price for electrons come down. How can the price for electrons come down? If we use different types of sources of electricity, in particular renewables and nuclear. Natgas is also on our radar because this is a short-term solution for the next 5 to 10 years. We believe long-term we have to be nuclear and solar. This is also what Elon Musk is saying. So we were happy with that thesis. And that's why we're thinking to invest in those assets. Now, the particular assets that we're thinking of is on the Natgas side, Range Resources, on the uranium side, Cameco, and on the solar side, we're still a little bit open, but we obviously have Tesla there, so we might just leave it at that and just invest in Cameco and Range Resources. So this is the formulation of the idea. In the discussion in the morning meeting, we went through the pros and cons. I think the negative here is in particular that you could have similar situations like in the noughties where you have too much supply of these things, particularly Natgas and uranium. Now let's talk about each of those factors separately, and I want to support the conclusion that we believe this time it's not going to happen, that the supply actually will be limited, also that the demand is actually pulling enough for the supply to not crush the prices. Let's start with uranium. Uranium is actually very abundant. However, it is fairly difficult to find the supply chain for uranium and all the kinds of uranium you need for the kinds of nuclear power that we tolerate these days. Without going too much into technical details, the way the uranium market works is that there is sort of a Saudi Arabia of uranium, which is Kazakhstan, and that's because Kazakhstan has inherited a lot of the old Russian nuclear assets. And Kazakhstan has this similar power. What I'm saying, Saudi Arabia of nuclear means that they have a lot of stock, and they can basically put things in the market or withdraw things from the market and therefore control the price. Now, of course, on the first side, and this is part of the reason why we have now invested in the space, is you don't want to depend on something like Kazakhstan. It's too risky, it's too volatile, there's no democratic regime there or anything like that. So you just can't, what if the leader there gets toppled? What if there's a revolution? Things like that could be a problem. Also, of course, we are talking about risks. We also always have the risk of nuclear accidents, which are, of course, scary also. So in that sense, we have to be very careful with nuclear. But having said that, we are in a situation right now where it has to come from somewhere, in particular for countries like China and India, where we believe, in particular China, we believe that electric cars will actually even surpass gasoline cars very soon. So you have to have some sort of electricity. It has to come from somewhere, and nuclear is the solution there. So the demand going up, Kazakhstan as a Saudi Arabia of uranium not behaving irrationally, in fact maybe even the other way around, so the price go up a lot. Of course they have to be careful also, they have to sort of follow the theory of Cournot and all that monopoly power stuff, that you don't want to also choke the market with too high prices, but you can reap what we call rents in economics by setting the right price with the right volume. Having said that, the question then is, of course, well, how high can the price go? The price can go pretty high. Investing in Cameco is, we're investing in an equity here, not in the actual uranium. That is probably up for discussion also. Why don't you buy directly uranium versus buying the company? Well, the company has more operating leverage than the uranium, so if you think uranium will go up, then you might as well buy the company. The gold standard is Cameco. It's a Canadian company with assets in Canada and other places around the world. So this would be one idea. On the Natgas side, we have a very similar view. So instead of buying Natgas, we just buy the best U.S. shale producer, which is Range Resources. They own vast amounts of assets in the Marcellus Shale, which is sort of the Norway or whatever you want to call it of Natgas. So massive resources. They own a lot of acreage. They have the infrastructure. They have the ability to market this stuff at good prices. We've been following this company for over a decade. We've never actually invested. The stock reached an all-time high of 95. It then went down to 5, and now it's in the sort of 20 range. So it is absolutely possible that this stock also sees levels maybe in the 60s to 80s, which of course would be a fantastic return. So these are the ideas. Again, I think we would also like to have some solar investments, but that is actually covered through Tesla. The potential in solar is, in our view, more on the technology side, so things like Enphase and Solar Edge would be interesting, but we're staying away from that from now. Given that we're fully invested, we would have to divest something, so we don't want to add to our leverage at this point. And that's, of course, another conversation. We probably would reduce some of our biotech investments and invest in this energy assets. We're thinking probably 10% of the fund would be an appropriate size, just to be big enough to be relevant. So it's not just a footnote, but also it's not the kind of idea that warrants 50, 60, 70% of the fund. It is a possibility. We haven't decided yet. What's negative about this, or negative is maybe too strong of a word, what doesn't support this whole idea is just that there really isn't much of technological innovation of sort of Deutschian solving problems, creating innovation stacks. It's not, I mean, you can argue that on the fracking side, so the Range Resources, they did build an innovation stack around shale gas, and then they're the best player in the US, I would say right now, at least best pure play player, I should say. There's probably good players out there like ExxonMobil and things like that, but pure play Natgas, Range Resources, definitely one of the better players. So we believe that is a decent investment. There is also an innovation stack there. It's certainly not the kind of innovation stack like something like SpaceX or Tesla that really can change the world, but it has some of that aspect. Versus Cameco is really just a resource company. There isn't much of an innovation stack there. You're just saying, look, there's a need for something that they have. That something is very difficult to come by. Yes, you can invest a lot of money if you want to replicate the supply, or you can just buy it from them and they, as an equity, will rise. So to summarize, we believe that electricity demand in the next 5 to 10 years has to go up a lot because of the electric car. We believe that electricity infrastructure has to change. We believe that, therefore, in particular, Natgas and nuclear will become interesting investments. There is also a chance that these assets, which have had their highs more than 10 years ago, could come back and even surpass those highs. So there's a bit of a technical viewpoint also on these stocks. It's a bit of a short-term trade in a sense that we believe that we can maybe 3-4x in the next to 3 years. So it's not something we might want to hold for the next 10 to 20 years, like Tesla or the biotech stocks. But it's a very, very good return, and it's something that needs to happen, and it will happen. If it happens, it will happen much earlier than when it's actually needed, because of course you can't replace the carpool by electric cars and then invest in the electric infrastructure. You have